Hello and welcome. This is KYC, a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Today, we have with us on our radar a company which has, in fact, seen initiation in coverage. This one is from the textile sector. Sanathan Textiles also recently listed, and we thought it would be a good idea to take this one up, considering we've had a handful of brokerages initiate coverage on this particular company. So, well, as the name suggests, it is in fact in the business of textiles. It has presence which spans across sectors, which would include something like polyester as well as technicals, technical textiles. And it has three yarn verticals, essentially: polyester, cotton, and yarns from technical textiles and industrial uses. So as you can see, it's a classic textiles company out there. And, well, it does see a lot of traction in terms of these three largely well-divided verticals. As far as the products are concerned, as on June 24, 2024, the company manufactures more than 14,000 varieties of yarn products with SKUs in the excess of, well, around 1,90,000. So it is significant in terms of the kind of traction that we are seeing for this particular company. And we're going to talk about the fundamentals of the company, sure, fair enough. But, at least as far as this particular company goes, well, like I said, mostly deals in polyester yarn, along with cotton and some of the other technical ones, where well, my colleague Mahima, when she joins us, will also give us a better idea of how the split comes through. Well, speaking of which, let's take a look at all the factors that we're going to talk about and judge the company on the base of what it has in fact done in the past. So naturally, we rate the company on the income statement. And then we talk about the balance sheet. The income statement will give you a fair idea of how things have panned out for its revenue growth, its operating profits. And of course, along with the balance sheet, we also talk about the cash flows. And based on that, the kind of return ratios that we are seeing as well. And we move beyond that to take a look at your shareholding, street credentials, valuations, and outlook, and that would give us a better idea of how things could potentially pan out for the company. But on that note, let's get in my colleague Mahima Vachrajani, who's also joining us, and to give us more insight into the company. So Mahima, welcome back. And thanks for taking the time to tell us about the top line and the profitability of this particular company. I'm really surprised that it did list at a very opportune time, especially given the fact that, well, what you're about to tell me.
Right, absolutely. It got listed on 27th of December, and that's when it did see good amount of listing gains as well.
Yeah.
But we'll talk about the stock performance a little later, in the show. But 9 months FY25 performance have improved quite a bit. The revenue stood at 2,266 odd crores. EBITDA stood at 195 crore. Margin stood at 8.6 crores, and net profit stood at 116 odd crores. Margins have improved from around 7.9% to 8.6. This 7.9% figure was in FY24. FY24 revenue stood at around 2958, and EBITDA stood at around 227 odd crores, and net profit stood at around 134 odd crores. So while the 2-year CAGR picture is a little down the road, but overall 9 months FY25 performance has been strong, and in terms of YY growth also, EBITDA saw a growth of around 32 odd percent, and net profit also saw a growth of around 43 odd percent.
So, that's as far as your top line goes. And of course, a lot of these numbers are from the DRHP, which also gives you an idea about how things have panned out for this particular company. And remember that if we are going to see a decline, it's really surprising that we've seen so much traction in its IPO, which means that the prospects of the company could potentially be much better. But I'm going to move and shift focus to the balance sheet there. And again, in terms of the balance sheet, it does have a significantly high gross debt. In fact, its net worth stands at around a little less than 1,400 crores, and its overall gross debt stands at around well over 1,600 crores. So it's well over 1:1 in terms of its debt to equity. Sure. Textile companies in general do have some amount of debt. A lot of this debt is required for working capital and to a certain extent expansions if they have that in plan. And we'll take this up with the management as well with respect to why this gross debt is still high, especially when they have in fact gone ahead and done the IPO, or whether or not the proceeds from the IPO have been used to a certain extent to reduce the debt. Because do remember that the company listed well back in December, and we're going to wait for more details and updates on that. But at the moment, we're going to give this a thumbs down because, you know, even the balance sheet is looking at a slightly higher debt number, which in turn has led to higher finance costs, which in turn has led to lower profitability number. So there's something, another factor that can weigh down on you know, the profitability of the company. So that's as far as your balance sheet is concerned. Mahima, what about cash flows?
Right. You know, just before I move on to the cash flows, just a brief about the IPO. You know, it was a fresh issue of 400 odd crores,
right,
and an offer for sale for 150 crores, out of which they had said that around 160 crores will be used for repayment of borrowings,
right,
and around 140 crores for investment in subsidiary, and of course, there also repayment of borrowings. So just to give viewers that context. In terms of cash flow, well, the cash flow from operations picture has improved for this particular counter. In first half of FY24, the cash flow from operations stood at around 16 crore, which has improved to 64 crores now in first half of FY25. But overall, net cash flows position has weakened a bit from around 5.7 odd crores in first half of FY24 to 14 odd crores in first half of FY25. And this is because of two main reasons. Cash flow from investing activities has seen an outflow of around 36 odd crores, and this is for the purchase of property, plant, equipment. So they might have made some investment when it comes to their manufacturing capabilities. And the other major investment was in their subsidiary, which was for around 77 odd crores, which is why overall net cash flow position has been negative 14 crores. But this is just the picture of first half of FY25. Probably considering the whole year picture, it might turn net cash positive, but that's something to wait and watch. But for now, since cash flow from operations have improved, we've given a thumbs up when it comes to you know, the cash flow metrics.
And that's probably the only reason why we are giving this company a benefit of a doubt in terms of the cash flows, because of the improvement in your cash flows from operations, and assuming that they are in expansionary phase, and that your net, under those circumstances, your net you know, cash flows or your free cash flows won't be present at this point in time, assuming that the company is looking to grow. But you know, that brings us to the matter of return ratios. It's not very encouraging. So firstly, you know, the company was working with staggering return ratios back in FY 2022. In fact, very, very healthy return on capital at around 36%, return on equity at around 44%. But this actually took a dramatic turn for the worse in 2023, and it came down to around 15.5% for ROCE, and ROEs at around 14.4%. And in FY24, this has, you know, come off even further to numbers which are well below 12%. Now, you know, if you go by the thumb rule of around 20-25% for both ROE and ROCE, well, the company is at a far cry from there. But I'd reckon that this, once again, will naturally be a consequence of certain challenges with respect to the entire sector, or for that matter, the company adapting to a certain change which may have led to these following ROEs and ROCEs. And the question then is that, can these numbers improve? It's something that we'll take up with the management as well. But for now, this is how things stand. So this is as far as your very important, you know, financial statements go. Let's look beyond and talk about the shareholding. Mahima, what can you tell us?
Right. So since it's just a recently listed company, we have the shareholding data as of 31st December 2024. Strong holding when it comes to the promoters holding, around 78.6% is held by promoters. FI's holding is around 3.8%, DI's holding is around 8.9%, and around 8.8% is held by public. In terms of the total market cap of Sanathan Textiles, it stands stands at around 2,600 odd crores, out of which around 380 odd crores is the free float available right now.
Right.
So that's the view with respect to how shareholding goes, but strong promoter holding, which is why we've given a thumbs up to the counter.
And of course, the promoter holding is slightly above the minimum that we
75.
require, that's 75%. So naturally, over the 5 years, we will see this equity reduce because that's mandated by the SEBI laws. But it has plenty of time, and it's not significantly above the 75% mark. So that's something I reckon that investors can keep in mind. But like I said, the company has plenty of time to bring their shareholding, the promoter shareholding, from 78.6% to 75%. But in terms of street credentials, as Mahima mentioned, that it had a very strong listing. And since then, we have seen a deterioration in your broader markets as well, where your mid-cap and your small-cap indices have come off significantly. And this particular company is no exception. So we have seen a 25% decline since its listing price. From its listing price. In fact, it's trading near its issue price right now, a little bit of depreciation there. And it is also down around 14% on a calendar year to date. So there has been weakness here. That's as far as street credentials go. But I reckon that, two of the most important factors that we are watching out for is valuations and outlook, because a lot of things hinge on this. So, Mahima, valuations.
Right. So, when valuation comes into picture, Sanathan Textiles as compared to its peers, the forward valuations look, attractive. And of course, this is on the back of the kind of growth also. So for Sanathan Textiles, we've taken the forward valuations from the ICICI Securities reports, in which they've said that by FY26, they expect the revenues to double for this particular counter, which is why, the valuations as compared to FY25 slightly rise to around 18.3. But when compared to peers, the valuations look attractive for Sanathan Textiles. KPR Mill, forward valuations as per Bloomberg stand around 32 times and will come down to 25 odd times. Vardhman Textiles has slightly lower valuations as compared to Sanathan Textiles, but it is not as diversified as Sanathan Textiles is. So it has, forward valuation of around 12.5 times and 11 times. Indocount has similar valuations as compared to Sanathan, and Garvey Technical. Although this Garvey Technical Fibers is, has more contribution coming in from the technical fibers segment, and that's why the valuations there are much more expensive as compared to Sanathan Textile. So forward valuations as compared to peers look cheaper, and the growth that ICICI Securities is penciling in, compared to that, valuations look attractive, which is why we've given a thumbs up right now when it comes to valuations. Yeah,
but as Mahima mentioned, that Garvare Technical in this case is a slight exception, which is why you may not want to consider that, but it is comparable to KPR Mill or Vardhman Textile. And of course, the case for the fact that the company is going to look at a very, very strong FY26. So speaking of the outlook, Mahima, I reckon that that's the reason why the company got such a staggering listing in the first place. So tell us about that as well.
Right. So, in terms of outlook, again, before I move on to that, ICICI Securities just day before yesterday came out with a report which have initiated a buy with a target price of 461. They're expecting a 3-year CAGR growth in terms of revenue, which is 28%. In terms of EBITDA, it is 42%. And in terms of PAT, it is 24%. They're saying that strong growth will be driven by commissioning of Punjab unit in first quarter of FY26. Now, what they're talking about, the Punjab factory, the unit that they're talking about, they are expanding their manufacturing capacity there. They have advanced stages of commissioning a greenfield capacity in Punjab, and they're also anticipating commissioning a cotton yarn operation of Unit 4 in Silvassa factory as well. In terms of capacity expansion plans overall, polyester as of FY24 stood at around 2 lakh 750 metric tons, which will go to around 4 lakh 56,000 metric tons by FY27. And for cotton yarn, which is around 14,000 metric tons as of FY24, will go to around 24,950 metric tons by FY27. This is the estimated capacity expansion that the company has planned. So this is the overall outlook. So outlook definitely looking strong. They are planning to add capacity, and plus we are also expecting the Bangladesh +1 strategy that will play its part. The UK +1 strategy also playing its part, which is where the growth will come in.
Right. So, well, we do have the management here with us, but I want to take you all through the overall ratings. And this is where the outlook and the valuations become extremely important. So, if you judge the company not by what it has done so far, but what it is expected to do, that's when things change completely and dramatically. Sure, a lot of the ratings that we've given the company are on the back of the history, but it does seem like the outlook is strong. It's not overtly expensive at the moment, which is why, maybe the ratings that we are giving to this company may not necessarily be something that you want to go by. That said, we're still looking at a 4 out of 8 as far as their overall rating is concerned. But on that note, let's get in the management of the company. We have Paresh Dattani. He's the CMD of Sanathan Textiles, and Sammir Dattani. He's the Executive Director at the company. Paresh, let me start with you. I reckon that all the focus is now going to be on what the top line can look like in FY26, your greenfield expansion that you have planned for, and the kind of contribution that can bring. So my first question is that if you could give us timelines on your greenfield expansion, and when can that start coming into play, and at what point in time will it start, meaningfully start contributing to your top line and your bottom line?
Yeah, good morning. As far as the Punjab facility is concerned, we are in the advanced stage of the plant coming up. We will be commissioning in the first quarter, FY26. And we will be starting that in a phased manner and coming up to the full capacity in about a month and a half or 2 months from commissioning. So that by the end of the first quarter or a month more than that, we should be down to the full capacity. So if you look at the overall capacity of this plant in the first phase, we have putting up 2,55,000 tons of filament yarn, which would give us a top line of about 2,900 crores. In the first year, that's FY26, we should do about 70% of that, which should be close to 2,000 crores. This and the existing Silvassa facility, which is giving us 3,000 crores in FY25 also. So we should end the top line of FY26 at about close to 5,000 crores.
Okay. Sammir, if you could give us an idea about, post-IPO proceeds, how they've been used, the impact it has had on your balance sheet, and what does your current balance sheet look like? So where does debt stand at right now, and if there are any plans to likely see this number change going forward, do you think that the gross debt could increase or decrease going ahead?
So in the IPO, we had clarified that the proceeds will be used to repay the debt. 400 crore rupees out of the primary will be used to repay the existing debt as well as the new borrowing for the new facility. We have completed that. We have repaid the 400 crores and reduced that burden on the balance sheet. All the other debt that you see on the balance sheet is only for the new facility, which is going to start up in the first quarter, like Paresh Bhai said. And going ahead, once the plant commissions, we're going to have strong positive cash flows to ensure that we continue to repay the debt in time in the coming years.
Right. Paresh, Mahima also joining in. I just wanted to understand that, there are huge targets when it comes to, increasing your capacity right now. What does the capacity utilization stand at right now? And what is the kind of capacity utilization that will take place once, in FY26, both your Punjab as well as your Silvassa Unit 4 capacity, is at its, full operation?
As far as the Silvassa is concerned, we are even today operating at full utilization, which we've been doing for the last couple of years. We've been stressing assets fully. As far as the Punjab facility, as I mentioned, FY26, we should do about 70% of the capacity. But the following year, we should be up to fully more than 95% utilization on the Punjab facility.
Sammir, in terms of your product mix in FY24, polyester stood at around 80%, and the balance was with cotton and other technical textiles. Is this mix likely to change as we move into the next couple of years? And does that also, what sort of an impact can it have on your operating margins?
So what's interesting about us at Sanathan Textiles is that we are, in three segments of the textile chain: in polyester, in cotton, and technical textiles. Now, if you've seen the current budget from the government of India, or all the kind of push and incentives that the government is giving, it's keenly focused on all these three textile segments: the polyester, cotton, and technical textile. Our current breakup, as you mentioned, is 80% polyester, about 15% cotton, and 5% technical textile. And our business strategy, our plans ahead are to expand in all these three segments, because we are very bullish on the kind of demand that India is going to see for all these three yarns in the coming years. With the growth in consumption, with the growth in e-commerce, brand, downstream, with the big brands coming to India and sourcing locally. And of course, let's not forget, globally, there's a Bangladesh +1 opportunity that India is poised to encash upon. All these things will require more yarns. So we are quite clear on our outlook in the coming years, and in sync with our outlook, we're expanding all three segments in a phased manner. The polyester facility starting first, where we'll be more than doubling capacity, after which we'll have an expansion in our cotton yarn facility, where we'll be adding at least 70% additional capacity from what we have currently. And then the technical textile, which is a small segment of about 5% currently, we'll be doubling capacities in that as well. So we are very well poised to ride this journey and this growth of the textile sector in India in the years to come.
And Sammir, as you rightly mentioned, there's Bangladesh +1 strategy that will also play its role. Right now, your revenue mix in terms of domestic to exports is that domestic is around 96% and the remaining 4% is exports. Do you think this mix will change from a longer term perspective, let's say by the end of FY27, and how will that change, and what will the margins be like then?
No, Mahima, if you see, in the last few years, our export has reduced a bit. And that's purely a business strategy, because the kind of margins and returns that we're seeing in the domestic market, demand is stronger. And I think that will continue because of the kind of geopolitical global scenarios that you're seeing. We feel like the India story is far more stronger, and our current business strategy is focused on about 90% revenue from our India domestic operations. Having said that, of course, we have a lot of customers who export our yarn products in the form of fabrics and garments. So those indirect exports will continue to grow because of the UK +1, Bangladesh +1, and all other such opportunities that the Indian textile industry will have.
Okay, so Paresh, just a clarification on your gross debt. At this point in time, what is your overall gross debt? And will this number come down in FY26 or FY27?
As on 28th of February, we have a debt of 947 crores on the subsidiary. Right. That is the debt we have taken to put up this plant along with our contribution. We have totally put in about 1,400 and odd crores already invested in the plant. And we long-term debt at the end of the project will be close to about 1,200 crores.
Okay. Yeah. All right. Well, there you have it. So there's a lot of clarity from the management that's been given, and especially when it comes to the outlook of the company. So not only are they looking at expansion, but they're also expecting demand to hold up, and that actually will play very favorably for the company. So a lot of tailwinds that the company is expected to look at, and of course we'll keep an eye on this one as well. But on that note, also thanking both Paresh and Sammir for joining us and giving us that much more clarity, that much more insight into the workings of Sanathan Textiles. But on that note, we are completely out of time on this edition of KYC. But lots more lined up on the other side. Stay tuned in, and we'll be back in just a bit.